Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. For markets, all eyes on the Middle East means that asset classes need perhaps to be seen through the lens of oil prices and the potential impact to the global economy. Will the relative calm in markets hold? And how do we put this type of event into context globally? Thankfully, joining us live from London today is Fidelity International Investment Director Tom Stevenson. He's going to help us find some grounding and perhaps a lot of noise of a new geopolitical reality. Welcome, Tom. Great to see you again. Hope you're well.
Thanks, Paola. Thanks for having me on the show again.
We're delighted to see you today and hopefully, as we say, make sense of some of the things that are going on in the world and how that ricochets into the economy. Let's just go through the events that are actually still unfolding in the Middle East. They continue to. We keep an eye on the oil markets, which haven't done a whole lot yet. What do we make? Is there an uneasy calm here, or is there somewhere? How are you reading this or hearing others reading this?
Yeah, well, I mean, you're right to say that the oil price is the focus here. I mean, clearly there's a huge amount of uncertainty about what the follow up will be to the events of the weekend, and all eyes are on how Iran responds. I mean, I think there are three possible things that could happen. We could have a sort of a back down, and the move towards a negotiated settlement, which clearly from a market perspective would be the most benign outcome. I think the second thing that could happen is that Iran could maybe sort of back away from sort of a military retaliation, but focus more on the Straits of Hormuz, that choke point of the Persian Gulf, where up to a third of seaborne oil traffic passes through there. That is the potentially the place where they have some leverage, and that would obviously have an impact on the global oil price. So that's the second possibility. I think the third possibility, of course, is the worst case scenario, is that we see sort of an escalation of the military conflict and the targeting of US assets, bases and assets in the region. So I think until we have a sense of where things are going, markets are going to remain relatively neutral. They're going to keep an eye on what's going on. But the oil price, I mean, the initial reaction was about a 6% rise in the price of Brent crude. That came back pretty quickly to just about a 1% rise. Stock markets were pretty flat, actually. I mean, when markets opened in Asia, I think we were down about 1%. Less than 0.5% here in Europe, and I think actually the last time I looked, just a few minutes ago, the S&P 500 was up about 0.5%. So stock markets are being pretty relaxed, I think.
So, I mean, is there a sense we're always sort of looking for why is it a resilience discussion that's why things are okay? We seem to bounce back from things faster than one might think, or is the stock market just doing exactly what it does and looking through further to another side of probably pricing in a slightly more benign outcome?
Well, I think what the stock market is doing is that it's looking in a totally unsentimental way about what is the likely impact on economic growth, and the reality is that the global economy is much less energy intensive than it was. Go back to the 1970s when, of course, the oil embargo had a massive stagflationary impact on Western economies. I think that what stock markets are saying is it's short of something sort of more cataclysmic, the economic impact is likely to be relatively contained. And at the same time, you have to look at the sort of overall supply demand balance of the oil market and recognize that the oil market is pretty well supplied at the moment. Most of the big oil producing nations have spare capacity. If need be, they could ramp up production. And also at the same time, demand is relatively subdued. But in the two major economies in the world, the US and China, demand is relatively down. And so that combination of lots of supply, relatively subdued demand means that I think that the oil price is likely to stay within a sort of the range that we've seen it in recently. It would need to go sort of well in excess of $100 a barrel, I think, to start to have a negative impact on global growth. And it feels like that's, quite some way off.
It is a departure from the history books for the price of oil as things happen, as things unfold in the Middle East. Has to do with spare capacity around the world. Has to do with a lot of different things. But as you're pointing out, there's an ability for the economy globally to power on to an extent in a way that it hasn't. Another departure from the history books of late, at least the last 20 years, is when we look at how the trade for equities in particular have shifted from a very US centric US exceptionalism story
Mm.
to a much more European, much more international diversification of equities around the world. This we're about halfway through the year, a little further than that. You've been watching this from the front rows. Is this a sort of, well, we knew it would finally happen? Or, I mean, what went into this? This happened, before April, before a
Yeah.
lot of things that have been big headlines. This trade had begun.
Yeah, absolutely. I mean, as you say, we're approaching the halfway stage, and so I think we've got that sort of half year scoreboard, if you like, coming up. It would be very surprising to me if we didn't get to the end of the month, and top of the list would be European shares. Now, that's 6 months ago, I think that would have surprised very many people. You roll back 6 months to the beginning of the year, and the sort of the US exceptionalism story was still very much alive and kicking. Europe was flirting with recession and really looked to be out of it in relative terms. So there's been a very significant shift, a rotation out of US assets into other parts of the world, and the major beneficiary of that has actually been Europe, which I think has taken some people by surprise. But there's in some ways what's happened with the whole sort of tariffs, trade war story through the first half of the year is actually in some ways been a bit of a gift to Europe. I would suggest, and in particular the kind of withdrawal of the US from its defense security guarantee for Europe,
Right.
I think has been a bit of a gift to Europe, because it's actually been a wake up call. It's forced the region to really take a hard, long look at where it's spending its money, what it's focusing on. And Germany in particular, which of course is the engine room of European growth, they've said, yes, we do need to spend more. We need to spend more on defense. We need to spend more on infrastructure. And that, I think, will in time be a real positive for European stock markets. And there are opportunities in the defense sector, for example, which investors around the world have really focused on.
And we're days away from a NATO summit that will have quite a different, we think, quite a different, just a different tone in terms of who's contributing ultimately, and that has shifted certainly. Do you think the moment where Germany realized it needed to change its spending and do things differently was when we saw Vice President JD Vance visit a European defense conference
Mm.
earlier this year and basically said you're on your own. That was sort of the message, wasn't it? And it was quite shocking at the time, but that seemed to be was that probably the turning point where the liquidity got turned on from governments, or at least the decisions to turn on the taps got made.
I think that was a catalyst. Absolutely, I think that was the moment when Europe realised that it needed to change the way it thought about its defence. And Germany for many years has been reluctant to spend in that way. And I think that the mood, just as in your part of the world,
Yes,
the
absolutely.
sense of the relationship with the dominant economic force and the dominant security force in the world has changed, possibly for good. I mean, by which I mean permanently. I think, I think the same thing has happened in Europe, and I don't think it's all a bad thing. I think there will be good positive things that come out of this change.
Yeah. Yeah. Send a thank you card, but not yet. Later. Yeah, later.
Yeah.
Um, no, it is fascinating. Let's talk a little bit about valuations within Europe based on everything that you've just been discussing, those 2 points that you were making. Valuations have come up substantially. It's been a win for European equities through the first half of 2025. I think there's a lot of questions about whether it has legs. Does it keep going? Have you missed it?
Mm.
Um, what needs to be added? You were talking about defense spending will creep up. I guess the question is it priced in?
Yeah. So I mean, I think first point, we started from a pretty low base in Europe in terms of valuations. So what we've seen over the last 6 months is a bit of a convergence in valuations. Very high valuations in the US have started to come down, and they've certainly started to rise. There's still a gap between the two, a significant gap. So I don't think that valuations by themselves are a reason to think that you've missed the boat, for example, with the European trade. In terms of earnings, actually, what we're seeing is a slowdown in the US economy, and that's feeding through to slower earnings expectations. And we're seeing the opposite in Europe. We're seeing earnings expectations are actually rising. So we're seeing a convergence there as well. And I think that is a precondition for a narrowing of the valuation gap as well. And then I think the other point that I would make, in terms of making the case for Europe, is what we've seen over the last couple of years is a sharp reduction in the cost of borrowing in Europe. The ECB has cut interest rates from about 4% to 2%, so they've halved in Europe, whereas what we're seeing in the US, very much the Fed sitting on its hands, waiting to see what the impact of tariffs will be on growth and inflation. Much to the irritation of the president, of course, because he's very keen for the Federal Reserve to get on with it and to cut interest rates. And in my view, quite rightly, the Fed is saying, no, hang on, let's wait and see what the impact is going to be. But that has opened up a significant gap in terms of policy between Europe and the US.
Well, okay, so let's go into there's so many pieces of this I want to ask you about, but let's go into the discussion of the dollar. The interest rate differential is huge between the United States and many other countries, Bank of England, Canada, that have been cutting and have been cutting for lots of good reasons in their own countries and different reasons. But in any case, the Fed is holding a bit longer, and there is this interest rate differential, which should make the dollar stronger. There's another number of stories for where the dollar is going right now. I wonder if you can sort of take on that differential and its impact on. Is it possible that currencies is actually maybe not geopolitical, but otherwise the story of the year so far?
Yeah, well, it's certainly an interesting story because, as you say, you would expect that interest rate differential to lead to a stronger dollar. You would expect the geopolitical uncertainty to lead to a flight to safety, the typical safe havens being the dollar and US Treasuries. We've not seen that happen. We've seen the
We've
dollar.
seen a bid today into the
We have
dollar.
today,
There
yeah,
is
and
that.
then almost for the first time in a
Right.
couple of months, the dollar has started to behave in a way that you would expect it to behave. But I mean, it's a fairly marginal increase. But yeah, you're right; it has been different today. But prior to that, we've seen a weakening of the dollar when you would not have expected it, and I think that is a reflection of a changing attitude towards the US's safe haven characteristics. It's in terms of the predictability of its policy, in terms of the what is broadly called the US exceptionalism story. I mean, it's there are now question marks as to whether the US will deliver consistently higher profitability and returns on capital in the way that it has in the past, and that's part of this rotation. Many investors over many years have become very heavily exposed to the US because of that exceptionalism story, and that is disappearing, and it's showing up in the dollar certainly. Now that has knock-on impacts for other regions and asset classes. For example, I was talking just this morning to one of my colleagues about emerging markets, and she was pointing out that dollar weakness is typically a positive for emerging markets for a number of reasons. It's good for commodity prices. It lowers the cost of servicing US dollar denominated debts, for example. So a falling dollar is normally good for emerging markets. We haven't yet seen that. And one of the reasons why we haven't seen it in emerging markets is that all the focus, as we've been discussing, has been on Europe. And I think so, if you were looking for other areas of the world where there might be interest to come, if you think, well, maybe if Europe's had its run, and it has certainly enjoyed a run, then I think emerging markets might be somewhere interesting to look at as well.
We often keep abreast of your articles that you write in the Telegraph, and one of them recently was actually looking at sort of the FTSE versus the American markets, and if you just bought and held all the way through for a big chunk of time versus another, and reinvested dividends actually. It has an interesting way of looking, although that's not the way the investor. I wonder if you could just take us through the tenets of this article. I'm trying to get people to go, but I also love this particular one.
Yeah, so this was an article that I wrote. I was really interested in the long-term relative performance of different markets. Well, I started actually thinking about the importance of reinvesting dividends, and so I was looking at the performance over time of different markets. And one of the things that surprised me was that if you look at the FTSE 250, which is the more domestically focused mid-cap index here in the UK, over a long period of time, I looked at 25 years, it had actually performed as well as the S&P 500 over that 25-year period. And that really surprised me. And I thought, well, why might that be the case? And one of the reasons, of course, is that the UK is typically quite a high dividend paying market. So, rolling up dividends over time makes a big difference. But one of the interesting sort of findings I stumbled on by accident, as you often do when you do a bit of analysis like this, was that I realized that most people don't just buy put a lump sum of money into a market and leave it for 25 years and forget about it. Most of us, if we're saving towards our retirement, for example, will be dripping money into the market over time, probably on a monthly basis out of our salary. And when I did the same analysis, but dripping the money in month by month, I got a totally different outcome. With that outcome, the US market had actually performed massively better than the UK market. And I was slightly puzzled by this. I thought, why would that be the case? And then the penny kind of dropped. Then I realized that it's all about the sequencing of returns, because the UK market did quite well in the early years of this century. So after the dot-com bubble burst and before the financial crisis, the US was not doing particularly well, but the UK market was doing better. The US market, by contrast, has actually done extremely well in the last 10 years or so. And what I realized was that, if you've been dripping your money into the market over that period, by the time you got to 10 years ago, you'd already built up quite a lot of capital. And so you had capital on which the super performance of the US market was able to work. So it struck me that, and obviously there's not much you can do about that, because you don't know which market is going to perform when. But it was just an interesting analysis that, if you torture that, I say, if you torture the data hard enough, you can get any result out of it. But this was a result that I hadn't expected.
Yeah, that is fascinating. It's so true that humans, the human nature is that you don't just sort of let it sit for 25 years necessarily, because often you don't have enough to put in at that time. Fascinating. Anyway, your articles are fantastic, and they're up there on the Telegraph, Telegram rather. Do you think, Tom, there'll be any impact on oil prices in response to Trump's call for them to stay low this morning? Yeah, I mean, we're going to hear a lot of calls for things for sure, aren't we?
So this is Trump's call for the oil price to stay low.
To stay low.
Yeah, well, I mean, ultimately that's that's probably not in his gift. I mean, my feeling is that the oil price is more likely to stay low because ultimately it's a supply and demand balance question. And as I was explaining earlier on, I think there's absolutely no question that the market is potentially well supplied for a long time into the future. If you look at the forecast from the IEA, for example, they're saying that they expect supply to grow well in excess of demand for the next decade or so. So I think actually, absent events in the Middle East, I think the underlying fundamentals of the oil market argue for a lower oil price, which is a positive for economic growth. It's a positive for inflation.
Yeah, absolutely. So interesting. Let's sort of switch back to not so much currencies, but the safe haven trade. Certainly, gold has been a big piece of that. I mean, the dollar fits in there usually. Want to bring us to the question of bonds as well, but let's just talk about this sort of perplexity of where the safe haven is, and probably a further diversification of portfolios on balance over the course of the last 6 months or so.
Yes, and I think that the whole question of diversification is changing quite a lot at the moment. I mean, for so many years we've had this very favourable situation where bonds and equities have been uncorrelated, or they've been negatively correlated. So they moved in different directions on the same stimulus, the same event. And that's been a very good environment for investors with a balanced portfolio because it's given them a relatively smooth ride over time. I think that as bond yields rise, and there are a number of reasons why bond yields, especially at the long end of the curve, are rising. I think that bonds and equities become more correlated. And that makes diversifying a portfolio much more difficult. And I think that investors can no longer rely on just a two-asset diversification. They need to look more broadly. And that's where things like gold, property, infrastructure, absolute return funds, they start to come into their own. And I think that the old 60-40 portfolio has really probably had its day, and we're looking for a much more broadly based, diversified portfolio in future.
In terms of geographic diversification, probably different assets as well, but just on the geographical, what about exposure to Asia? China has had an interesting sort of 8 or 9 months, so some real bids to growth, and then kind of calming back down again. Japan is also a place that many people have been looking of late. They were
Mm.
less hit by tariffs, but there's still sort of a lingering piece there.
Yeah, I mean, there are different stories in China and Japan. I mean, I think the Chinese story is to a large extent about stimulus. I mean, if you look at what's happened in the last 5 years, the US market has really been driven very strongly by stimulus as we came out of the pandemic. In China, they had a totally different situation. They had much longer lockdowns and almost no stimulus. What we're seeing now is a bit of a reversal. We're seeing the fiscal situation tightening a bit in the US, but the Chinese are now looking at in particular, stimulating the consumer. And I think that that's a positive for the Chinese market. It's helping China move more towards a domestic consumption driven market rather than an export driven market. In the context of tariffs, that's important as well. So I think that's the positive story for China. The Japanese story is rather different. In Japan, what we've seen in the last couple of years is we've seen the return of what I call good inflation. In the West, we tend to think of inflation as being a bad thing. And in Japan, where they've had years and years of deflation, actually a return to 2 or 3% inflation is really a positive. And what we've seen most recently in Japan with what they call the Shunto wage round, the spring wage round, at which pay rises are negotiated, we've seen very strong growth in wages in Japan, and so that is feeding through into more consumer confidence. So I think that the Japanese domestic economy is really looking a lot stronger than it has. And I think you're right to mention tariffs with regard to Japan, because Japan is exposed to a new tariff regime in the US. But if it has a strong domestic market, which it clearly does at the moment, then I think that can be a positive for its stock market.
I want to just circle back to the discussion of what's worked so far this year. There's been a large European and international diversification, but emerging markets as of now perhaps have not. I mean, what would you call? I want you to say the words, not me. Is there sort of an untapped opportunity there? It's a very interesting thought, and
Yeah. I
yeah.
think that emerging markets do look like an interesting area at the moment. I think the weak dollar is traditionally a positive for emerging markets. The emerging markets space is completely dominated by China. China is interesting when it comes to the tariff situation, because although China is very much in the sights of the US when it comes to tariffs, in stock market terms, it's arguably less important, because many of the listed Chinese companies have a much more domestic focus than the unlisted export-focused Chinese companies. So actually, you could argue. In fact, I saw a figure that says something like only 3% of revenues of listed Chinese companies are actually directly affected by the US. They're exposed to the US. Very low percentage. So I think that's something which maybe investors have not really thought about, that actually China in a listed company context might be relatively protected from tariffs.
And is almost, well, not a place to hide in a traditional haven sense, but may either be a beneficiary or just not included in the story. So a couple of weeks ago, we had lots of US auctions of 30-year bonds. There was sort of some concern going into it, whether that would all be lapped up, and it was. Could you share, Tom, your comments on the long-term bond, please? Yeah.
Yes, I mean, I think that what we're seeing with bonds is we've got this two-way pull with the bond market. On the one hand, we've got the prospect of a slowing economy leading to modestly lower interest rates. I don't think interest rates are going to tumble in the US, but I think that interest rates will come down, and that should bring bond yields down, which should be good for bond prices. On the other hand, we've also got this growing what they call the term premium, which is the compensation that investors demand for lending long term. So this affects the long bond, lending for a long period of time, compensation for the risk of inflation, compensation for the risk of policy uncertainty, and that is rising. So the term premium, which was almost negligible, is now pushing up to 1, maybe even 1.5 percentage points. And so that arguably takes long bond yields over 5%, and that starts to become a tricky place, both for bond investors, but also as a spillover into the equity market, because when you've got long bond yields of over 5%, that actually reduces the incentive to take the risk of the stock market. So the long bond market is really very important looking into the future.
In 30 seconds, can you answer this question? Here's the question.
Right.
Do you think the UK economy could become as strong as the German economy in terms of industrialization? We haven't really put a lot of UK questions to you. But
no, we haven't. No, I mean, I think short answer is there are a lot of very strong companies in the UK, but I do think that the UK also has some deep-seated problems in terms of government finances, public finances, and I think that we've got a budget coming up in the autumn. We're probably looking at some quite punishing tax rises in the UK, which I think is going to be a bit of a headwind for the UK.
Okay, very interesting. We'll certainly talk to you more on that as we get closer to it. Wishing you a very good start to your summer, Tom. Thank you for joining us.
Thanks, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.